Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, thank you, mate. Thanks. No, that's right, no, got it working. Thank you. Thanks. Okay, sorry for the delay. We'll make a start while this is loading up. There was a problem with the, thank you. There was a problem with the screen not working. Apparently it's fixed now. We'll see. Okay, so next week you have a quiz. Thank you. Next week you have a quiz. It'll be in the last about 10 minutes of your tutorial, and it's based on today's lecture material. Now what I'd like to do is I'd like to tell you in advance the topic that your quiz will be on. Okay, so some of the things that people worry about is that people later in the week have an advantage over people at the beginning of the week in terms of quizzes. So I like to tell you what the topic will be on. Very good, it's working. So as we get towards the end of today's lecture, I will tell you what the quiz will be on, and I'll also put a notice up on Wattle as well, so that everyone has has that information. The really important thing to remember, though, is that when you attend your quiz, you have to attend it in the tutorial you are enrolled in. Okay, if you go along to another tutorial, the quiz won't count and you get 0. Okay, so that's in the course outline. So you must attend the tutorial that you are enrolled in for the course. Okay, if something comes up, you need to let me know in advance, and depending on your reasoning, and it has to be good reasoning, then I might give you permission to attend another tutorial. Okay, but you need to let me know very well in advance. And also I was told that the overhead slides last week weren't recorded by Echo, so apparently that's been fixed, so it should be recorded today. Please let me know if you have problems again. Okay, so today's lecture, what are we doing? Today's lecture is all about forwards and futures contracts, and we move to a different world. We now move to a world where we have continuous compounding, and that means something's happening all the time. Okay, so things don't just happen every quarter, things just don't happen every day. Okay, they happen every single second. Every single second things are being traded. Every single second something is happening in the marketplace, and that needs to be reflected in the way we deal with equity prices themselves. So the two types of assets we talk about today, we talk about consumption assets and we talk about investment assets. So all those formulas that you covered in Foundations and Finance, they pretty much work for what we call investment assets. Okay, so things like gold, interest rates, foreign exchange. Okay, but however, there are some assets out there called consumption assets where the formulas may not hold. And we deal with that at the end of the lecture today in a bit of detail, well, in the middle of the lecture today in a bit of detail. So the best way to think about it is, and while this is, I don't know why it's taking so long, loading up, we'll go to the document camera. Okay, let's just do it like this. Okay, so we have a particular consumption asset. This is the formula you should all be familiar with from Foundations of Finance. Okay, so your futures price or forward price is equal to the spot price today multiplied by 1 plus the risk-free plus the cost of storage. Okay, raise the power of T. And we talk about arbitrage scenarios. So why we say the left-hand side has to equal the right-hand side is because if it didn't, so you either had a greater than or less than sign, thank you guys. If you had a less than or greater than sign, you could make an arbitrage profit, okay, by buying low or by selling high. So in this case, if you had greater than, so the futures price is greater than the spot price, multiplied by all of that stuff, buy low, sell high, you'd be buying the underlying asset. Okay, you'd be borrowing the money to borrow the underlying asset, and you'd have to repay the risk-free and pay for the storage costs. And then on the left-hand side, you enter into a short futures contract. So let's think about a consumption asset like oil. In that case, that strategy will work. You're happy to go and buy some more oil. A company will go and buy some more oil. The problem, though, is if you get the less than sign. Okay, so the less than sign. So, your arbitrage strategy there would be to buy the low side, the left-hand side, so a long futures contract, and then to sell the underlying asset. The problem is with consumption assets, that strategy doesn't always work. Okay, so imagine you have the companies that own the oil, right, or hold the oil, they're big refineries. Okay, so what do the refineries do? They take the oil and they turn it into another product. Okay, so they turn it into petrol, they turn it into plastic products, or other items out there in the marketplace. So what you'd be saying to those refineries is, we know your main business is converting oil into a product, but don't do that, just get rid of the oil. And then the business wouldn't be able to do anything. Okay, so you can't have that selling pressure on the underlying asset when it's something like a consumption asset, something that's used, and then there's heaps of seats down here, guys, if you're looking for seats. Okay, you might have to walk across some people. Okay, so you can't get that selling pressure with consumption assets because the oil refinery won't be selling its oil. Okay, it won't be selling its oil because it needs to turn it into something. If it doesn't have the oil to turn into something, it has to shut down. It no longer operates. Okay, so it's not going to be selling the oil. It has to turn it into products. That's how it makes its business. Okay, so with consumption assets, these formulas don't necessarily hold. Okay, but what we're going to do later on is we're going to try and get an equal to sign there by talking about something which we term a convenience yield. Okay, so what is the convenience? What is the benefit of being able to hold the oil? Okay, in terms of if you are a refinery. Okay, so we'll have a look at that a little bit later. Okay, but that's what the first part of the slides are talking about in terms of consumption assets versus investment assets. Okay, good. These are loaded up. Okay, so we've spoken about that. So let's just review this idea of short selling just to make sure everyone's happy. Okay, so I am holding in my hands a BHP share. If we think that the price of BHP is going to go up, what would you do? Buy it. The price goes up, you sell it later for a higher price. That's how you make your profit. The question is, if you think the price of BHP is going to fall, what do you do with it? How do you profit out of that? Okay, so if you owned a BHP share now and you thought the price was going to fall, you'd just sell it, right? Because it'll be worth less a year from now. But if you're someone who doesn't own a BHP share, then the question is, how do I profit? As someone said, what do? You short sell, right? So this gentleman over here, thank you, he owns the BHP share. It's currently worth, let's say, $20 a share. I'm out there in the marketplace. I believe the price of BHP is going to fall, so I enter into this short sale arrangement. So what I do is, this guy here, he wants to own this share no matter what. So a year from now, he wants to have one BHP share in his hand. Okay, that's what he wants. So he lends me this BHP share, and I promise to give him back one BHP share next year. Okay, so no matter what happens, he'll own a BHP share 1 year from now. I take this share worth $20, I sell it, doesn't matter to who, I sell it and I get the $20. I then go invest it at the risk-free rate of interest. Okay, or I invest it in something else. It's now a year later and the gentleman says, I'd like my share back. I go to the marketplace and I buy one share off anyone, doesn't matter who it is. Okay, so let's imagine I buy it off this woman here, and it's now worth $10. So I give him back his one BHP share, but also happens during the year a $1 dividend is paid. I also have to give him the $1 dividend, because it has to be like he held that share for the whole year. If he'd held it for the whole year, he would have got the $1 dividend, and he'd have one share. That's what he has now. He owns a share, and he has his $1 dividend. It just happens that the share price fell by $10. That would have happened whether he'd lent it to me or not. Share price would have still fallen. So he's no worse off. Share price has fallen, but he owns the share, and he gets his $1 dividend. As for me, well, I sold it for $20, so it's a positive $20 cash flow. I then had to buy it back for $10, and then I had to pay the $1. $1, so I made like a $9 profit there. Okay, plus I invested at the risk-free rate of interest. Okay, that's all well and good, but the share price could have gone up. It could have gone up to $50, in which case I would have had to pay the $1 dividend and I would have lost $30 on this short sale trade. Okay, so it's not guaranteed. This is just me entering into a short sale position or contract. Is everyone happy with that idea? How it works? Remember, like we said last week, if this had have been an asset such as gold, which had storage costs, if he'd lent me the gold, remember how he can be no worse off, he can also be no better off. So if he'd held that gold for the year, he would have had to pay the storage costs anyway, so he has to pay me the storage costs as well. And that way, he's no worse off, he's no better off. Why does he ever enter into this short sale? Why does he lend me the assets? Okay, because even though we tell you it's free, no money changes hand, a little bit does change hands. Okay, so he kind of get like a brokerage commission, a brokerage fee for entering into this short sale. Okay, so maybe on that $20 BHP share, he gets 10 cents. Okay, you can say, well, that's not a lot. Well, he wouldn't have got that 10 cents unless he'd enter into this. Okay, so he gets the share back, he gets the dividend, and plus he gets 10 cents. Okay, a small brokerage amount. But we don't talk about that in this course or in any of our formulas. That's just how it works, okay, in the real world. Okay, so in terms of a bit more operationalization, how it works, in terms of entering into this, you'd also, a bit like a futures account, you'd have a margin account as well. Okay, so imagine we entered into this trade, okay, and imagine it was for 50,000 BHP shares. I'd have to have some money in a margin account, or I might have to have some shares in a margin account, some BHP shares, okay, to sort of cover any potential that I may not be able to pay him back. So as prices move against me, okay, if prices go up, then some money would go into his margin account to make sure he's got that money from the prices going up. So it's just making sure there's some security in place so that he doesn't get nothing at the end, or I run away with the money or the shares. In terms of the regulations we have in place, so in Australia, only certain shares can be short sold. So it's called the ASX, the Australian Securities Exchange Approved Securities List. So it lists all the shares, all the companies, sorry, on the stock market in Australia that you're able to short sell the shares. Okay, if the company's not on that list, you cannot short sell shares in that company. And in Australia, you can only short sell up to 10% of the shares in a company. So if currently 9.5% of the shares have been short sold, the maximum that can be short sold will be another 0.5%. So at any point in time, the total amount of short sales can only be 10% of the shares in a company. Okay, so that means you can't short sell 90% of the shares in a company. If you dumped 90% of the shares in a company on the stock market, of course the share price would fall. Okay, supply and demand. Okay, and that would be what we call market manipulation. Some controls they have in the US, so it varies depending on the time. One of the rules they have in place is called an uptick rule. Okay, that means you can't short sell shares in a company unless the most recent traded price was an increase in the price of that company. Okay, so if the most recent price was a fall, you're not allowed to short sell it. You have to wait until the share price goes back up again. That prevents cascading, okay, a huge decrease in prices going down. By limiting when you can short sell it to only when the price goes up, okay, that means you can't put a huge force of dumping pressure of shares on the marketplace. Okay, so we're going to talk about interest rates at the moment, and we're going to talk about the continuous rates. Okay, so we'll talk first of all, how do we change, how do we change the formulas that you learn in Foundations of Finance? Very small changes. And then we'll talk about how you convert interest rates. And the really good thing is there's really only one formula you have to remember for converting interest rates. Okay, so continuously compounded. So down here, if we look at $100, okay, to see how it grows through time. So in Foundations of Finance, you would have said $100 multiplied by 1 plus r to the power of t. Okay, with continuously compounded rates, instead you say $100 multiplied by e, which you'll see on your calculator, and then you raise it to the power of the interest rate times the time. So if your interest rate is 5%, it'd be 0.05 times 1 if it's for 1 year. If it's for half a year, it would be a half, and so on. Okay, so t is just measured in relation to a year. Is it a 12th of a year if it's a month? Okay, is it 2 if it's 2 years? Okay, and if you discount, then you'll say, so I want to bring that $100 back in time, maybe I want to bring it back a year, sort of present value terms. I get the $100 a year from now. What's it worth today? I take my $100 and I multiply it by e to the power of negative r times t. So in Foundations of Finance, you would have said either $100 divided by 1 plus r to the power of t, or you would have said $100 multiplied by 1 plus r to the power of negative t. Okay, so same thing, you just say 100 times e to the power of negative r, your interest rate, times t. How far you bring it back in time? 2 times 0. Okay, so on your calculator, you'd say e to the power of the interest rate's 10%, e to the power of 10% times 1, right? And that would work out what's my effective interest rate. Okay, so if you're told I've got a 10% per annum interest rate, compounded continuously, how much do you actually earn over a year? What's the actual earning? Okay, so that's going to be e to the power of just r times the amount of time you're talking about. Okay, so you'd actually earn 10.51%. Okay, so in Foundations and Finance talk, that nominal rate of 10% per annum, okay, that's the quoted rate, but because it's compounded continuously every single second, the actual effective rate, the interest you actually earn over a year, is going to be 10.51%. Okay, and we know the more frequently you compound something, the more interest you earn because you earn more interest on interest. Okay, so that's why you end up with 10.51%. Okay, I want to do something now about talking about converting rates, and then we'll get back to the lecture slides. Is that too big or is it okay? I'm having problems zooming. Okay, so again, this is just bringing it back, talking about how we think about things in Foundations of Finance to how we think about things now in this course. So in terms of, excuse me, in terms of your future values, Foundations of Finance, future value was your cash flow multiplied by 1 plus r to the power of t. In this course, it's just your cash flow multiplied by e to the power of r times t. Present value was your cash flow divided by 1 plus r to the power of t. Okay, in this course, it's the cash flow multiplied by e to the power of negative r times t. So this is the main way you'll have to convert interest rates in this course. Okay, and the formula is in your textbook, I think on page 85. Okay, and this is the main formula you will use. Okay, so the continuously compounded rate is equal to m times the natural log of, in brackets, 1 plus the rate you've been given divided by m, where m is the number of times it's compounded in a year. Okay, so m is the number of times your interest rate is compounded in a year. So all the formulas that you use, the interest rate that you use has to be a continuously compounded rate. Okay, so if in a question I tell you the continuously compounded rate is 8%, that's the number you put in to your formula, right? That 8% because it's continuously compounded. The question is, what if I give you a rate that's not continuously compounded? So if we look at this example, what is the continuously compounded rate? If I tell you the nominal rate is 10% per annum, compounded weekly. So we use our formula. How many times a year is that rate compounded? If it's compounded weekly? 52. Okay, so just to refresh everyone's memories, there are exactly, when we do this compounding, we assume there are exactly 52 weeks in a year, exactly 365 days in a year. There are 4 quarters in a year. If it's semi-annual, it's compounded twice a year. If it's fortnightly, it's 26 in a year. That's just the convention, that's the practice of how often they're compounded. Okay, so remember a few years ago when I was lecturing Foundations of Finance in an exam, I had a 10-year period and it was compounded daily, and a student got into an argument with me and said, well, at least a couple of those years will be leap years, so it should be 366. Okay, no. Okay, the convention always is that we assume 365 days a year. Okay, even if it's a leap year. That's the actual compounding you receive. Okay, so please keep that in mind. So, 52 weeks in a year, so very simply, remember that formula, the continuously compounded rate is going to be the number of times it's compounded in a year, which is 52, multiplied by the natural log of 1 plus the nominal rate of 10% divided by the number of times it's compounded in a year of 52. Okay, so that's going to give me my continuously compounded rate, which is 9.99%. That's what I use in my formula. Okay, 9.99. 10% per annum compounded quarterly, 4 times, that's the number of times it's compounded a year, 4 times the natural log of 1 plus 10% divided by 4 gives me 9.877%. So that's the value of R I'll use in my formula, if that's how frequently the cash flow is compounded. 1% per month. How would I do that? Well, I'm going to do it in a couple of steps. First of all, I'm going to work out, well, 1% a month, how much is that over a year? So basically, I'm just calculating the effective interest rate. So it's 1 plus that 1% per month to the power of 12, something you would have done in Foundations of Finance, to give me 0.1268250301. Keep all your decimal points, just like in Foundations of Finance. Don't round. Keep everything you see on your calculator. In exams, in quizzes, when you write down your formula, don't say 0.12 ... Okay, because the extra 10 seconds it takes you to write out 68250301 2 or 3 times in your answer. Okay, if you make a mistake on your calculator, I don't see the interest rate, I can't give you a mark. If I see you actually have calculated the correct interest rate, you will get a mark. Okay, so don't save 5 seconds of your time, okay, by just doing ... It's not ... It's 68250301. The way I set my exams is I always, in my head, you may disagree, but in my head I set exams where you have more than enough time to do the exam. So if I set you a 3-hour exam, I think it should take you a little bit over 2.5 hours to do the exam. So you've got plenty of time. Okay, you should never be sitting in one of my exams rushing. Okay, so please take your time, check your work, write down everything. We can only give you marks if we see what you've done. Okay, we can't know what's in your head. We can only see what's on the paper. Okay, so that gives me my continuously compounded rate. Sorry, that gives me my effective rate. So how many times would that interest rate be compounded in a year, if that's my effective rate? Once, right? Because that is the total amount of interest I earn over a year. So plug it into my formula. 1, because it's only compounded once a year, natural log 1 plus all of that divided by 1 gives me 11.94039702%. That is my continuously compounded rate. Okay, so once you've practiced these a few times, okay, you should be fine. But I can guarantee you, whether it's in a quiz or whether it's in an exam, you will need to use this formula at least once, okay, to convert interest rates. Okay, so start practicing now, but it's really simple. Just the number of times it's compounded in a year, multiply by the natural log of 1 plus your interest rate divided by the number of times it's compounded in a year. Really easy to remember. With your calculators, if this is the first time you've dealt with natural logs, okay, you want to make sure when you're doing your calculations, you use the ln, okay, on the calculator, the ln. Don't use log, because that's going to be a different log. That's going to be log base something else, most likely log base 10. Natural log, ln, is log base e, and that's what we're dealing with, all the continuously compounded rates. Okay, so just double check that on your calculators to make sure you're not making a careless mistake there. Okay, let's go back to the lecture notes. Okay, so what are the assumptions we make? And these are the same assumptions you would have made in Foundations of Finance. Okay, there are four main ones. Okay, the first one is no transaction costs. Okay, so that's not real. That's not what happens in the real world. Because if you go and buy shares, you do have to pay brokerage fees. Okay, but all this is all about what we call the marginal investor. The marginal investor, and you'll learn this in investments, is the person or the group of people who actually decide asset prices. It's not you and I. Okay, so for Australian shares, it's normally a large international hedge fund, okay, or mutual fund who decides asset prices of shares in Australia. And for them, they do not face transaction costs. Okay, they buy shares in bulk, off market, and they pay nothing to buy them. Well, they pay the price, but they don't pay a commission to buy them. Okay, so it's all about who's doing this stuff. They are subject to the same tax rate on all net trading profits. Okay, so the same tax rate no matter what. They can borrow at the same risk-free of interest as they can lend money. Can you and I do that? No. You and I cannot borrow at the risk-free rate, and we also can't lend at the risk-free rate either. But again, the marginal investor, large corporations, they certainly can get access to capital at the risk-free rate of interest. Okay, and they're the ones who set the prices, so they're the ones we worry about. And they take advantage of arbitrage opportunities as they occur. Okay, well they don't, they have computer algorithms to do it. Okay, so if there's a greater than or less than sign, they automatically trade and get some money, make some money out of it, right? Using none of their own assets. Okay, so we spoke about this last week. So that's just this idea here. How do we come up with the forward or future price? Okay, so again, last week, what did we say? Well, you can do one of two things. You can either buy the gold today, so you've got it in 6 months' time, or you can enter into a forward or futures contract to buy it in 6 months' time. Either way, 6 months from now, you own the gold that you need. Okay, if you're a jeweler, whatever you are. Okay, but if you make the decision to buy the gold today, you've got to pay the spot price today, and you've also got to pay the risk-free rate of interest from borrowing the money to buy the gold, and you've also got to pay any storage costs that may come across. Okay, so that gives me my futures price is equal to the spot price multiplied by e to the power of, now if it doesn't have any storage costs, RT. If it does have storage costs, we'll talk about that as we go through the different formulas today. Okay, but that's just the basic idea that arbitrage is I can do one of two things, buy the asset today or enter into a forward or futures contract for the future. Either way, I end up with the same asset 6 months from now. Okay, so let's have a look at this example. Okay, so, actually, so go back to here, sorry. Okay, so we have a 4-month contract to buy a zero coupon bond that will mature 1 year from today. Okay, so a 4-month forward contract to buy a zero coupon bond that will mature 1 year from today. The current price of the bond, so its spot price, is $9.30, and my risk-free, it's continuously compounded, so I don't have to do anything with it, is 6% per annum. So what have we done here? This is today. This is day zero. Today you enter into a 4-month forward contract. That means you're entering into a contract to buy this bond 4 months from today. Okay, so when do the cash flows occur? You buy the bond 4 months from today. But when you enter into this forward contract today, this particular bond has 1 year remaining in terms of its total life. Okay, so the bond matures 1 year from today. So this is when the bond matures, 12 months from today. If you actually end up buying the bond 4 months from today with your forward contract, it will have 8 months to go until expiry. Okay, so just drawing a timeline, make sure you know where all the cash flows occur. You enter into a forward contract today, you buy the bond 4 months from today, and it matures 8 months later, which is 12 months from time zero, 12 months from today. In terms of the formula, straightforward. My spot price multiplied by E to the power of 6%, my interest rate, and we're valuing the forward contract. So what we care about is what is the life of the forward contract. I don't care about the life of the underlying asset. Okay, when you did, in Foundations of Finance, when you did forwards or futures contracts on shares, you never took into account that we assume shares last forever, have an infinite life. All you valued is what is the length of time of the forward or futures contract. That's what you're doing here. This forward contract matures in 4 months' time, so it's 6% multiplied by 4 on 12. It's positive because I'm looking into the future. It matures 4 months from today. So I punch all of that in my calculator, and I get $948.79. Okay, so I'm locking to buy this particular bond for $948.79. Any questions? Okay, so then we talk about our arbitrage ideas. Okay, so again, we touched on this last week. Arbitrage is all about the buying low and selling high if there's a mispricing. Okay, so if there's a mispricing in the marketplace, we can make a riskless profit using none of our own money. Okay, so we borrow assets off other people, we borrow cash off other people, we don't use any of our own resources. Okay, so we buy low, we sell high, and here's the first case we can have. The futures price is greater than the spot price, multiplied by E to the power of R times T. So at the moment, we're just dealing with a really simple asset that has no storage costs at all, and has no income, has no dividends. It's just a basic asset. Okay, so if it's greater than, what do we do with the left-hand side? Out loud, we short, fantastic. And what do we do with the right-hand side? We borrow to buy. Okay, so we short the forward, we borrow and buy the underlying asset. Because we borrow, we've got to pay back the risk-free rate of interest. That's why we have R here. We've got to worry about the risk-free rate. If the futures price is less than the spot price, multiplied by E to the power of R times T, what do I do to the left-hand side? Long. That's right. What do I do to the right-hand side? Short sell. Excellent. So I long the forward, and I short sell the asset and invest the proceeds at the risk-free rate of interest. Any questions? Okay. So now we start introducing the other types of assets. Okay, so we had a simple one, had no storage, has no income. Okay, now we start including the income. Now in Foundations of Finance, you pretty much dealt with it as in terms of it paying a yield, okay, some sort of percentage. But in this course, we're going to look at all the different variations that can occur. So first of all, imagine you buy an asset and you know it pays a fixed dollar dividend every year. Okay, so you know the value of the dividends, what they're going to be. So your formula, just like in Foundations of Finance, remember how you remove the dividend from the current share price? Right, so you would have said S0 times 1 plus R minus Q. You subtracted the dividend yield. Here, with the dollar dividend, we just subtract the value of the dividend from the current stock price. But what we subtract is the present value of the dividend. So if you enter into a forward or futures contract today, and a dividend's paid in 3 months' time, then you have to discount that dividend back to time zero. So you have to bring it back 3 months. Okay, because you know exactly when it's been paid. It's being paid 3 months from today. Today it's not worth that amount. You've got to reduce the time value of money, the 3 months worth of interest on the dividend. So in this example, consider a long forward contract to purchase a coupon-bearing bond whose current price is $900. We will assume the forward contract matures in 9 months. We also assume that a coupon payment of $40, okay, so that's my income. $40 is expected after 4 months. The 4-month and 9-month risk-free interest rates continuously compound at a 3% and 4% per annum. So what on earth is going on there? Why do I suddenly have new interest rates? Well, you have new interest rates because interest rates aren't flat. They don't remain the same. So now when you think about when your cash flows occur, you need to match them up to the interest rates that correspond with those cash flows. Okay, so that dividend that's paid in 4 months' time, you've got to discount it back at the 4-month interest rate. Working out the life of this contract as a total, well, the life of the forward contract is 9 months, so we have to use the 9-month interest rate. Okay, so you need to match up the timing of the cash flows with the interest rates. So first of all, we need to find the present value of the cash flow we receive. Okay, so the cash flow was $40. So we're going to say $40 multiplied by e to the power of negative RT. I want to bring that $40 back 4 months. I get it in 4 months' time, so I have to bring it back to time 0, that coupon, sorry. So I'm going to say $40 multiplied by e to the power of negative 3%, because that's the 4-month interest rate, and I want to bring it back 4 months, so 4 on 12. So that gives me a present value of that coupon of $39.60. And then to work out the value of my forward or futures contract, it's just the spot price of $900 minus the present value of the coupon, $39.60, multiplied by e to the power of 4% was the 9-month rate, multiplied by 9 on 12. Okay, and that gives me a forward price of $886.60. Okay, are there any questions there? Yeah, that's correct. So what you've done is, you have the spot price today of 900, right? You have to subtract the income you receive. So remember in Foundations of Finance, you always subtracted the income. In Foundations of Finance, which we're about to do in 1 minute's time, you did that by just subtracting the yield, okay, the dividend yield, okay? So what we have to do here is now we have to remove, again, the value of the dividend. Okay, well that dividend, I've got the spot price today, I need everything in today's dollars. So that dividend is in 4 months' time. I need to bring it back to time 0 so it lines up. Okay, so I discount it back 4 months at the 4-month interest rate. Yeah, because if I invested for 4 months, I could get that 3% rate. Now I've got everything in today's dollars, and now I can say, well, what's the value of this forward or futures contract? Well, the total value today is 900 minus 39.60, okay, because I've subtracted the dividend, and now I need to compound it up or get its value in 9 months' time. So I use the 9-month interest rate.
Can we just put it in a space after the 15 months and get the future value of dividend, and we use the 900?
No, it's probably easier. It's probably easier to do it like this. Yep, yep. Okay. So the question was, can we do everything at the end, like compound it up for 5 months? Well, you couldn't because I haven't given you the rate between 4 and 9. You'd have to have the rate between 4 and 9 months, which I haven't given you. Okay, so you don't know what it's going to be. You'll figure out how to do that next week, but at the moment you don't know how. Okay, so bring everything back to time 0 is probably the easier way to go. Okay, so now we get to a bit more familiar terms, what you did in Foundations of Finance. So in Foundations of Finance, you know how you subtracted the dividend yield? Okay, that's what we're going to do here. Okay, so the formula becomes the spot price multiplied by E to the power of R minus D, where that's your income, percentage yield, how much you get over a year. Okay, so R, the risk-free rate, minus my percentage income, multiplied by T, how long it's invested for. Okay, so we have an example here. Consider a 6-month forward contract on an asset that is expected to provide an income equal to 2% of the asset price once during a 6-month period. The risk-free rate of interest with continuous compounding is 10% per annum. The asset price is $25. Okay, so what you've been given is 2% every 6 months. Okay, so kind of what you've got there is 4% per year semi-annually compounded. Okay, you don't want semi-annual compounding, you need continuous compounding. So we need to convert it using that formula I showed you at the beginning of the lecture. So to do that, we use M. How many times is it compounded in a year? Well, it's paid twice a year, so it's 2. 2 times a year, multiplied by the natural log of 1 plus my 4% yield. That's what I get over a year, divided by 2 to give me 0.0396. Now I have a continuous rate for my income. I have a continuous rate for my risk-free of 10%. So now I can plug it into my formula. So the forward price is given by today's spot price of $25 multiplied by E to the power of my risk-free of 10% minus my yield of 3.96%, and it has a life of half a year, 6 months. Okay, to give me $25.77. Stock index can be viewed exactly the same way. Okay, you get the income that you receive in terms of a dividend yield. In Foundations of Finance, what did you learn about what you deal with stock indices? What are they in values of? They're in values of points. So what did you do in Foundations of Finance to convert them to a dollar value? What was the convention you used? Do you remember? Wasn't that long ago? What did you multiply the points by to get a dollar value? Sorry? $25? Okay, so the convention in Australia is we would multiply the points by $25 to get a dollar value. However, it really depends what index you're looking at. So in your textbook, it'll use all sorts of different values. In the US, there are some indices where it's $100. There are others where it's $150, others where it's $250. Okay, I'm not expecting you to memorize all of those. Just say, if you have a question and I don't tell you otherwise, multiply by the convention, which is $25 per point. Okay, so unless I tell you otherwise, use $25. But if I tell you in a question that each index point is worth $100, then you'd multiply by 100. Fantastic. Okay, but if I don't tell you, use $25. If I tell you, obviously use what I tell you in a question. Okay, but the convention we use is $25 per point. And it's exactly the same as what we did before. Same formula, R minus D. Okay, so we have a 1-year futures contract on the ASX S&P 200, so the top 200 companies in Australia by their market capitalisation. We have a dividend yield of 5% per annum, continuously compounded. We have a risk-free rate of 10%, continuously compounded. So my formula simply is the futures price is the spot price of 3,529 multiplied by E to the power of my risk-free of 10% minus my dividend yield of 5% to give me 3710. That is a point value, 3710. If I wanted to work out what a dollar value is, I just multiply it by $25 and get $92,750. Any questions? Okay, we've gone over that. Okay, let's have a break for 7 minutes, and we'll come back at 12:02. If you have any questions, please come down and see me in the break. Okay, so just to clarify, thank you, just to clarify a couple of questions I got during the break. So in any of your formulas for, thank you, for forwards or futures contracts, or whenever you're using continuous compounding, the value of T, right, is expressed in terms of the time period that you're looking at. Okay, so if you're looking at a 4-month forward contract, so the forward contract has a life of 4 months, T will be 4 on 12. Okay, if you're thinking about the contract has 22 days till expiry, then it's going to be, thank you, 22 on 365. Right, so the fraction of the year that you're looking at. If it's 2 weeks, it's going to be 2 divided by 52. Okay, so always think about it as a fraction of a year. Okay, so if it's weekly, you'll divide by 52. If it's monthly, you'll divide by 12. Okay, just in terms of the T value you have there. Okay. The other question I got was in relation to, where's my example? Okay, so this example here. So the question is, when you convert, so what you've got here, if you like, are periodic rates. Okay, so I gave you the formula for converting from nominal to continuously compounded. That was my m times the natural log of 1 plus Rm on m. The other situation you can have is when you have a periodic rate. Okay, so in the overhead slides in the lecture notes, I gave you 2 ways of doing that, and you can choose whichever way works best for you. Okay, so the one way you can do it is you can convert from, what have I got here? You can convert from a periodic to a nominal and then plug it into your formula, and that's what you've done here. Okay, so it's 2% every 6 months. So to convert that periodic to a nominal, I take the 2% and multiply it by 2 because you get 2% every half a year, right? And then it's compounded, if you like, twice a year. So that's the way we did it here. You went from periodic to nominal and then plugged it into your conversion formula. The other way you can do it is the way I did it on this slide, where I converted from a periodic to an effective. Right? So I said it was 1% every month. So I said 1 plus 1% to the power of 12, calculated my effective, and then took the natural log. What I could have done is I could have said 12 times the natural log of 1 plus 12 on 12. It would have given me exactly the same number. Okay, so either you convert from a periodic to an effective or a periodic to a nominal. It doesn't matter. It'll give you the same number. So whatever works best for you. I have no preferred way. Okay, but if you go back to your interest rate wheel, okay, from Foundations of Finance, right, that's all we've done there. In one step, we went from the periodic to the nominal. The other method, we went from the periodic to the effective. Okay, either way, you'll get exactly the same result and same answer. Okay, so with the stuff we spoke about before the break with indices, forwards and futures prices, and then arbitrage, buy low, sell high, a problem that can happen is that sometimes you can't execute the trades fast enough. Okay, not so much a problem today, but if we think back to the big 87 crash, okay, how people traded then was you'd have a dot matrix printer and it would print out the trades for you, the buy and the sell trades. Okay, a dot matrix printer is very slow to print out. Okay, and the problem was all these sell orders came in, right? And in the stockbroking firms, they were printing them all out. Because you had thousands, hundreds of thousands of sell orders printing out, the buy orders that came in later weren't being printed out because they were in the queue. So you had all these sell orders and no buy orders coming in. Okay, so that kind of amplified the effect of the crash that you had on something like the 87 crash. Nowadays, because it's all automated, you see the buy and sell orders coming in at the same time. Okay, so theoretically, as long as people are wanting to buy, which doesn't necessarily mean it'll happen, right, then you should have some buy orders in the marketplace so you can execute these arbitrage strategies. Okay, so we've dealt with income in terms of a dollar value, income in terms of a yield. The other income we can think of is if you hold a foreign currency. So if I'm an Australian and I hold US dollars, I get an income from holding those US dollars, and that income is the US risk-free rate of interest. Okay, so the US risk-free rate of interest. So just like I have to subtract my income from my risk-free rate, I have to subtract my foreign income from my risk-free rate. So this formula, if you like, becomes the forward or futures price is equal to the spot price today multiplied by e to the power of, now that R should really be an RD for R domestic. Okay, what's the Australian if you're dealing with Australia? What's the risk-free rate in Australia minus RF, the foreign risk-free rate? Okay, so the risk-free rate in the US. Okay, so my domestic risk-free minus my foreign risk-free rate of interest. Okay, now we talk a little bit more about commodities. And then we'll deal with consumption assets. So with things like gold, silver, even wheat or wool, they don't provide me with an income just sitting there. Okay, once I have the gold, it doesn't multiply, it doesn't grow, it just sits there. Once I've harvested the wheat, it sits there, it doesn't grow either. Okay, not unless I go and plant it or do something with it. So it doesn't provide me with an income. It's got a value attached to it, but it doesn't give me additional income like shares provide dividends. But what can happen is, of course, there are storage costs associated. Okay, so that's my Q, my storage costs. Okay, so the top formula would be if there's no storage costs, and my bottom formula is if there's a dollar value of storage costs. Okay, so in 6 months' time, I've got to pay $50 for storing my wheat. It's going to be spot price today plus the present value of that $50. So I've got to discount it back 6 months at the 6-month interest rate, and then multiply it by e to the power of my continuously compounded rate that matches the life of my particular forward or futures contract. If it's a percentage, which normally it would be, then I just have to add on my storage costs. So the formula becomes the spot price today multiplied by e to the power of my risk-free plus my cost of storage Q. So is that 2, 3, 4%? And what do we have to remember about that Q? What must it be? What sort of interest rate? Nominal, periodic, what should it be? Continuously, thank you, continuously compounded. Okay, it's still got to be a continuously compounded interest rate. Okay, so it's got to match up. So continuously compounded rate. Okay, so now we're going to deal with our consumption assets. And this is the way I like to think about it. Okay, so we have some assets, right, which we don't necessarily need to consume. We don't call them consumption assets necessarily. And we have a formula, right? The forward price is equal to S0 times E to the power of R plus Q times D, or it could be R minus D if it provides income. Okay, and if it's an investment asset, then it's very easy to buy and sell, to transact on it. Okay, so because it's easy to buy or sell the underlying asset, then if there's greater than or less than signs, depending on what you need to do, you can easily short sell the asset. Okay, to make that arbitrage profit such that you get the equal sign. The problem with consumption assets, okay, so let's deal with this case. You can have, if you like, 3 worlds, where the left-hand side is equal to the right-hand side, so everything's in balance, or you can have a world where the left-hand side is greater than the right-hand side. So in that world, you would take a short position in the futures contract and a long position in the underlying asset. Okay, so you'd be going ahead and buying whatever the underlying asset is. Okay, and with consumption assets, that's fine. You can go to someone who is pulling oil out of the ground and say, I'd like to buy some oil off you. They'll say, fine, no problem. Where you get a problem is in this case, where the futures price is less than the spot price multiplied by E plus R plus Q times T. In this world, you enter into a long futures and you have to short sell the underlying asset. Okay, so what you have to do is you have to take the companies that currently hold the oil, so the oil refineries, and you say to them, let me borrow your oil for a year. I'll return it to you a year from now. You'll be no worse off because in a year from now, you'll have your oil. Right? So you'll have your 500 million barrels of oil, whatever it is. So don't worry about it. And they'll say no. And they'll say no because in that year, they can't do any business, right? Like we said at the beginning of the lecture, they can't make the plastic products, they can't make the petrol, whatever they want to turn the oil into. So they won't let you short sell the asset in the quantity that you need. So therefore, you can live in a world, or you can be in a world, where the futures price is less than the spot times E multiplied by R plus Q times T. You can end up in that world, such that this is the formula we end up with some consumption assets. The floor price is less than or equal to the spot times E multiplied by R plus Q times T. Because we can't necessarily get rid of these arbitrage opportunities here. They could persist in the marketplace. However, this is finance. We don't like inequality signs, we like equal to signs. So what we do is we build in a value, right? A value for companies holding this particular asset, and we call it a convenience yield. And we add this convenience yield to the left-hand side. So we say built into the price of the forward or futures contract is the convenience of holding oil. So the fact that oil companies need to hold the oil to make products out of it. Okay, the refineries need to hold it. So they get a value from that, and it's called a convenience yield. Because you're going to increase the price of the left-hand side, then you can get to an equal to position. Right, so you end up with F0 times E to the power of Y times T is equal to S0 times E multiplied by 1 plus Q times T. And realistically, that's all you need to know about consumption assets. All you need to know is that with some consumption assets, you can't make arbitrage profits. Okay, that's all you really need to know about it. And that leads us to valuing forward contracts. Okay, and this is what your quiz will be on next week. Okay, so your quiz next week will be on valuing forward contracts. So why do we need to value a forward contract? Okay, so today I enter into a contract to buy gold for $1,000 an ounce at the end of the year. Let's say in 6 months' time. And I lock in a price of $1,000. What's that contract worth to me today? What's its initial, what we call its initial value? So today I lock in a forward or futures contract to buy gold in 6 months' time. What's that piece of paper worth? Zero. It's worth nothing. Because anyone else out there could also enter into a futures contract to buy gold 6 months from now for $1,000. Okay, so gentleman down here could do it. Woman over here could do it. So it's got no value. It's got a value of zero. What happens, though, as you go through time, this forward or futures contract can get value attached to it. Okay, it can become valuable. Okay, so let's imagine it's 3 months later. It's 3 months later, and no, let's make it 4 months. It's 4 months later, and this gentleman down here enters into a contract to buy gold 2 months later. So essentially the same day I've locked in to buy gold. Okay, so time 0, I was buying 6 months later. At time 4 months, he's buying 2 months later. So we're both buying at that 6 month time frame when I compare to today. Okay, today I locked in $1,000 to buy in 6 months' time. In 4 months' time, he locks in a price of $1,200 to buy gold 2 months later, the same day I've locked in to buy gold for $1,000. What's the value of his contract when he locks in to buy gold for $1,200 in 4 months' time? 0. Because anyone else on that day could also lock in to buy for $1,200. But now me, I've got some value. Right? Because I've locked in to buy for $1,000. So my forward contract has some value now. If I wanted to, I could sell or give my forward contract to someone else and they'd give me some cash. So how much cash would they give me? Well, they'd give me the new forward price of $1,200 minus the price I had locked in of $1,000, so $200 difference, and the present value of that. Okay, so when does the cash flows occur? In 2 months' time, right? Because remember, we're now 4 months into my 6-month contract. He's locked in to buy in 2 months' time. So I'd say 1,200 minus 1,000 multiplied by e to the power of negative r times 2 on 12. Bring it back 2 months to the time period that we're transacting at today. So my piece of paper that cost me nothing has a value attached to it, okay, of the present value of $200. And I could just go and sell it in the marketplace and receive the present value of $200. Let's imagine same situation. I locked in $1,000. It's now 4 months later, and this gentleman, the new futures price is now $500. Price has gone down. What's the value of my forward contract? Well, it's obviously negative. He can lock in to buy for 500. I'm locked in to buy for 1,000. So it's going to be the new forward price of 500 minus my price of 1,000, negative 500, the present value of negative $500. So if I wanted to get out of my forward contract, and I gave it to this gentleman over here, I'd give him the forward contract to buy for 1,000, and I'd have to give him the present value of $500. Right, the difference between the forward price on the day he could enter into it and the one I'd originally locked in. So it could have a positive or negative value associated with it. And that's what you see here. Okay, that's just what it's explaining. I kind of like to think of it more, think about what you've got compared to someone else. Are you better off or positive? This is the way the textbook talks about it. Okay, so in terms of F and K, if you want to do it like that. Again, in your quiz, I'm not looking for formulas. Right? You don't have to write down F minus K times e to the power of negative RT. You can say, here's my original forward price, here's the new forward price. I subtract it, multiply it by e to the power of negative RT, and I'm better off or worse off. Right? That's its value. It's positive if I'm better off, negative if I'm worse off. So if we deal with what these numbers, if you want to use the formula though, F, if you like, is the original forward price that you locked in. So in my case, that original $1,000 forward price that I locked in. That's my F, the original forward contract. K, sorry, no, see that, that's K, sorry. K is my original forward price. F is the new forward price. Right? Okay, so K is the original one I locked in. F is going to be the new one. Okay, either way, it's the way we spoke about it before. Okay, so if you're in the long position, then you're going to say the new price minus the original forward price and find the present value. And if it's a short, you're going to reverse it because you're in the opposite position. Okay, you're locking in to sell rather than locking in to buy. And you just find the present value. Okay, but hopefully it should be clear to you. I mean, I'm not too fussed about the F and the K, right? But hopefully it should be clear to you. If you've locked in a price to buy that's low and the forward price later ends up being high, you're in a better position. So it's a positive value. If you've locked in to sell for a price and the price ends up going up, you're in a worse position, right? You've locked in to sell for a low price, someone else can lock in to sell for a high price, right? So it's going to have a negative value attached to it, that particular forward contract. Are there any questions? So where would I use this stuff? This is how I would cancel out my forward contract. I no longer want to be in it. I give it to someone else. They either give me some money if the situation's improved, or I have to pay them some money. if the price has moved against me. Okay, this is if I don't want to wait to the end, I want to lock it out early. Okay, so let's have a look at an example. We have a long forward contract. This will be very similar. Okay, this is a nice and hopefully straightforward quiz to start on. Be very similar to the wording here. A long forward contract on a non-dividend paying stock was entered into some time ago. It currently has 6 months to maturity. The risk-free rate of interest is 10% per annum, continuously compounded. Stock price is $25 and the delivery price is $24. Okay, what is the value of the forward contract? So, when it says the delivery price is $24, that's the original contract you locked in. Okay, you locked in to pay $24 for this asset. What you have to work out now is what is the new forward contract price. So to do that, we take the current spot price of $25 and we multiply it by e to the power of r times t. So e to the power of my risk-free of 10%, it has 6 months to go to give me 26.28. So the original forward contract you entered into was $24. The new price is 26.28. Are you better off or worse off? You've locked in to buy, so you're better off. You can buy for a cheaper price, so you know it's going to be a positive value. Even if you stuff up just subtracting one from the other, you know you should be better off, so it should be a positive value. So we take the new forward price of 26.28, we subtract the one you originally locked in of $24, and then we just find its present value. Okay, there's still 6 months to go in the life of this contract, so we have to discount it back 6 months. So we multiply it by e to the power of negative 10%, that's my continuously compounded rate, times half a year, to give me $2.17. Okay, so that original forward contract I entered into for $0 was originally worth 0, now it's worth $2.17. Okay, key things to remember. When you first enter into a forward contract, it has 0 value. As you go through time, it will either end up with a positive or negative value, depending on the way prices move. Again, we spoke about this last week. In a forward or futures contract, there's a time period called the delivery period. It's normally a few days before the contract expires. In that delivery period, the person in the short position can force delivery. So that means they call up the person in the long position and they say, I'm delivering you the asset tomorrow, this afternoon, whenever it is. So it could be any day in that delivery period, not just the final day. And they can force delivery, which means they give you the asset and you have to give them the cash. Okay, you have no choice if you're in the long position. You have to say yes in terms of if delivery is forced. Okay, hedging strategies. So we know we use forwards and futures contracts to lock in prices. Forwards are good in a way because they're really highly tailored. You can take delivery of something in 212 days' time. Okay, it can be a random asset that's out there. Futures contract, trade on the exchange, right? They normally mature every quarter on a certain day, so it's not continual maturing, and it's only for certain assets. It doesn't cover absolutely everything in the marketplace. So with futures contracts, we actually end up with, very rarely do we have perfect hedges. We actually have imperfect hedges. Okay, so imagine you've got a futures contract to buy oil on the 15th of December, because that's when it matures, but you actually need the oil on the 1st of December. Well, there's no futures contract that matures on the 1st of December. Okay, so it's not going to be a perfect hedge because there's a 14-day difference between the 1st and 15th of December. So that type of risk arises, and we call it basis risk. Okay, so perfect hedge will completely eliminate risk. The problem is that it's very difficult to do perfect hedges with futures contracts. Okay, so we know a short hedge would be you're selling futures contracts, and that's appropriate when you own an asset and you want to sell it in the future. So remember, we're not talking about speculation here. With hedges, you actually want to buy or sell the underlying asset. So either you own it and you want to sell it, or you don't own it and you want to buy it. And you worry about the price rising if you want to buy it, and you worry about the price falling if you want to sell it. So it's all about trying to lock in or get some certainty about what the price might be. Okay, but it's really difficult to do that, actually, as it turns out, with futures contracts, because the timing of the cash flows don't necessarily coincide. So there are some companies that don't hedge. Okay, so a lot of the mining companies have no hedges in place. They're happy to sell what they dig out of the ground for whatever its spot price might be. Okay, some of our mining companies. Why do they do that? When a company like Qantas spends a lot of money hedging the price of aviation fuel. Okay, its single biggest cost. So some people argue, and you'll know this from Foundations of Finance, who should be the people who care about the share price? Shareholders. What do we assume shareholders own? What sort of portfolio? A diversified, the market portfolio, right? So if we assume that companies should care about their shareholders, and we assume that shareholders care about the market portfolio because that's what they hold, they've already diversified away firm-specific risk, right? So they've diversified away the risk of the price of iron ore falling because they hold a true market portfolio. All they're left with is our market risk. Okay, so what's happening to GDP growth? What's happening to unemployment? Okay, so there's an argument that companies shouldn't manage risk because shareholders already hold well-diversified portfolios where those firm-specific risks don't matter anymore. However, that's not the way it really works. Right? If you own shares in Qantas, and last year they made a profit of $1 billion, and next year they make a loss of $1 billion because they decided, hey, let's not hedge anymore. What happens? You sack them, you vote them out. Right? You say you didn't manage your risk properly. Right? And as shareholders, you control who runs the board. Okay, so while it's very well to say in a pure market theory context, we shouldn't care about managing risk for individual companies because, hey, shareholders hold everything, that's not the outcome. Right? Because if companies don't do well, board of directors get voted out, takeovers happen, all sorts of things happen. Okay, so companies do invariably try to manage their risk. Okay, and they try to manage their risk because they want to maximize their profits. And if each company maximizes their profits, then maybe or hopefully that's better for all the shareholders as a whole. Of course, if you hedge and you're wrong, that's the last one that's here, well then, shareholders won't be happy either. Right? So it's kind of like a lose-lose scenario. You go ahead and hedge your Qantas and the price of aviation fuel halves. Oops, you're locked in to buy for a higher price. Okay, well then maybe you make the argument to use options. But then shareholders say, why did you spend $50 million on options that you didn't need? Right? So therefore I've got $50 million less in dividends as a result. Also think about what your competitors do. Right? If your competitors don't hedge and turns out better for them and you do hedge and you've lost money, again, how do you sell that to your shareholders? Right? Maybe you'll be taken over as well. And the well-diversified we've spoken about. Okay, so we're going to talk about basis risk. And we're going to do it by overheads. So what is basis risk simply? Basis risk is the risk that the final futures price is not the same as the final spot price. Remember back to last week? This thing here? Convergence means that the final spot price always equals the final futures price. That is true with absolutely every single futures contract out there. The reason we're talking about basis risk today is because you may not hold this contract till the end of its life. You have to close it out early because you don't want to buy or sell the asset on the 15th of December, you want to do it on the 1st of December. So that means you're going to be somewhere down here, where the futures price will be different to the spot price. And that's all that basis means, the difference between the spot and the futures price. So let's have a look at some scenarios. And again, like we did last week, we're going to talk about cash settlement, right? And if you think about it, with futures, it's very likely to be cash settlement because you want to buy the asset on the 1st of December, not the 15th of December. So you wouldn't use physical. You'd use cash and just get the cash, buy in the spot market or sell in the spot market and have a difference in your futures account. So let's look at this scenario here. You've locked in on August 1st to a futures contract to buy gold for $1,500 per ounce on the 31st of December. Okay, that's your futures contract that you've entered into. Buy gold on the 31st of December. So let's look at a couple of different scenarios. Let's imagine on October 15th, so now 2.5 months later, someone else wants to also buy gold on the 31st of December. So what we'd have to do for them is find out what is the futures price on October 15th. To do that, we take the spot price on October 15th and we multiply it by e to the power of r plus q times t. So all this is trying to reinforce is that futures prices change all the time. Just because today you lock in a price of $1,500 doesn't mean that's the price that holds all the way until the 15th of December. For other people entering on different days, the spot price will be different. Time to maturity will be different. Maybe interest rates have changed. So that affects what the new futures price could end up being. Okay, so all this changed. So let's imagine here we end up with a new price of $1,600. So that brings us back to our idea of convergence, that futures price change all the way along. As we attempt to change, as prices change, final futures prices will also change. Okay, but if you lock in a price on one day, okay, then that's a good thing. Right? If prices go up a lot, you're not affected because you've got that lower price locked in with the futures. Okay, so what I'd like to do now is we're going to look at a case of basis risk arising. Your lecture notes, I'll show you this, ignore this. Okay, so your basis, they talk about F1, F2, B1, B2, all this sort of stuff. It's just confusing. Right? This is the way the textbook talks about it, so it's here, but I'm going to give you the way I want you to think about it. So if I ever ask you a question on this in an exam, this is the way I want you to think about it. And it's just a bit more logical than thinking about F2s and B2s and all sorts of other stuff. So sorry, I've changed the prices a little bit. Okay, so we are long in a futures contract to buy an ounce of gold on December 31st. But the futures price, is $650. Okay, so you've locked in to buy your gold. Ignore the 1,500 example from before. You've locked in to buy your gold for $650 an ounce. Okay, that is my futures price. The original spot price, so that's the price today when you enter into this futures contract, is $620. So your textbook talks about initial basis and final basis. What is basis? Who remembers? The difference between the futures price and the spot price. So at the end of the life of a futures contract, on the day it expires, what should basis be? 0. Because at the end of its life, the final spot price will equal the final futures price. The problem we face today is we're closing these contracts out early. So my initial basis is just going to be the difference between the futures price and the spot price. Okay, again, I don't really care about this. I'm not going to examine you on initial basis. Right? Of course it's different. Right? If they were the same, I'd be surprised. Right? Because we've got 5 months to go until the expiry of this contract. So, let's imagine scenario 1. You do close this out at expiry. Okay, so you stay in this contract all the way till December 31st. As we said, the basis should end up being 0, and it will be, because at the end, by definition, the futures price must be equal to the spot price. So we end up with, these are just made up numbers, we end up with a futures price of 660 and a spot price of 660. So there's 0 basis at the end of its life. We've reached convergence. Okay, they are equal to each other. However, this is what we're talking about. We want to close these contracts out early, because you don't want the gold on the 31st of December. You want it on November 30th, 1 month earlier. But there was no futures contract that expired on the 30th of November. So all you could do was choose the contract that expired after the 30th of November, but the closest to the 30th of November. And that happened to be this 31st December futures contract you entered into. So what happens on the 30th of November? Well, the spot price on the 30th of November is $660 an ounce, and the futures price is $665 an ounce. So the way the textbook would like you to think about it is you'd say S2 minus F2, so the final spot minus the final futures gives you -5, and so the effective price you pay is the $650 futures price you locked in at the beginning, minus the $5 here, which is $645. I just find that confusing. So I'd prefer you think about it like this, which is our cash settlement. So the spot price, again, is $660, and the futures price is $665. So if you're long in a futures contract, what's your payoff? What's your payoff from your futures? Is it the final futures minus the initial futures, or the initial futures minus the final futures? What's your payoff? So you might sit there being a little bit worried and confused, right? Because you're thinking in your head, isn't it ST minus F? Right? And that would happen if you closed it out at maturity, because the final spot price would be equal to the final futures price. But remember, with a futures contract, you have a margin account where you post daily losses and gains. And what you do is you compare what's the futures price on that day to the futures price the day before. And depending on whether it's higher or lower, some money goes into your margin account or goes out of your margin account. So if you're long in a futures contract, your payoff is equal to FT minus F0. So the final futures price minus the initial futures price. So in this case, the final futures price was $665, and your initial futures price was $650. If it was short, it'd be the other way around. Initial futures minus the final futures. Okay, so we're doing cash settlement. So we want to figure out, that means I know I'm going to have to go and buy the gold in the marketplace at spot price, and then I'll either have made some money or lost some money on my futures position. So to work out if I've made or lost money, my payoff is FT minus F0. So the final futures price is $665. That's the futures price on November 30th for settlement on December 31st. You had locked in on August 1st, $650 for a settlement on December 31st. So in your margin account, you have an extra $15. Right? You've got an extra $15 in your margin account. You close out your futures position and you realise that $15 cash benefit. But with cash settlement, you think about the futures. Now you think about what happens in the spot market. Well, now you've got to go and buy the gold in the spot market for the current spot price on November 30th. And the current spot price on November 30th is $660. So you pay $660, you've received a benefit of $15, so net you pay $645 for this gold, which, strangely enough, is a better position than you thought you would be in. you thought you'd locked in to buy gold for $6.50. Because spot prices and futures prices have moved in your favour, you actually end up paying a lower price. But you could end up paying a higher price if they hadn't moved in your favour. But what you've assured is that you've got something close to that $650 you originally locked in. But as you can see, it's not a perfect hedge. Okay, it's not a perfect hedge because you haven't locked in $650 exactly. And the reason for that is you're closing these contracts out early. If you close it out at expiry, sure, it would have been $650, but you can't. Right? You need that gold on November 30th. Okay, and that's why basis risk arises. And that's why we don't, with futures contracts, necessarily have pure perfect hedges. Okay, they can be imperfect. Okay, so this is the stuff that affects the basis risk. So like I said, why does basis risk arise? Well, one of the reasons is you don't have a futures contract that matures when you need to buy or sell the underlying asset. So therefore you choose the futures contract that matures just after you need to buy or sell the underlying asset. And you know what? Sometimes there aren't futures contracts on what you need to hedge. That's a problem as well. So for a long time, there was no futures contracts on aviation fuel. You couldn't get them. So instead, companies like Qantas would use futures contracts on heating oil. Okay, because in the US, the heating oil futures market is very highly traded. And it moved similarly to aviation fuel, right? The main input is oil. Okay, so it was a close approximation, but it wasn't perfect. So again, it's going to be an imperfect hedge, right? You're looking at differences in what happens on the futures prices of heating oil, and maybe it's highly correlated with aviation fuel, but it's not a perfect hedge, okay? Because we know the spot price of aviation fuel will not be equal to the spot price of heating oil, okay? They're different, but they move in similar directions, okay? So it was an imperfect hedge, but at least it worked a little bit. So therefore, when there's no futures contract, you choose something that's highly correlated. So heating oil being highly correlated with aviation fuel. Oh, and there's an example there. Okay, so how do you go and work out how many contracts you should have? Okay, so this is the kind of what we call the optimal hedge ratio. Okay, so how should I account for the fact that I'm hedging with a different asset? Okay, so my optimal hedge ratio will be equal to the correlation between the assets. Okay, so how I look at the price series of heating oil, I look at the price series of aviation fuel, and I see how correlated they are with each other. And it's probably something like 0.9. Okay, so pretty highly correlated. Remember, 1's a perfect correlation. And then I work out what's the standard deviation of the spot price, okay, of what I'm wanting to hedge, divided by the standard deviation of the futures contract that I can use. Okay, so that would be my heating oil. Okay, to work out some sort of ratio. The other thing we can look at is I want to hedge my portfolio of shares. And let's imagine my portfolio contains 50 companies. But if I look at futures contracts out there, there's probably only futures contracts on the ASX 200. Okay, it will probably move similarly to my 50 companies, but it's not exactly the same. Okay, so it's an imperfect hedge. Okay, so how do I try and account for that? Okay, and I can use this formula to do that. So what's the beta of the market? 1, right? The beta of the market, remember from Foundations of Finance, is always 1. So what I do is I look at the beta of my portfolio. How risky is my portfolio compared to the market? So if it's got a beta of 1.2, my 50 shares, compared to the market, it's 20% more risky. Okay, so I have to build that in, and I say 1.2, that's my beta, and I multiply it by P, right, which is the value of my portfolio. So my 50 companies, what's their value? Is it 20 million, 30 million? What's the value of my portfolio? And I divide it by the value of one futures contract. But in this case, the futures contract's not on my 50 companies. It could be on the ASX 200. Right, so that's going to be the points of the ASX 200 futures contract multiplied by $25 per point. Okay, so in this example, so the SPY 200, that is a futures contract on the ASX 200. Okay, so you would have done this in Foundations of Finance. You may not have exactly discussed what the SPY 200 was, but the SPY 200 is a futures contract on the top 200 companies in Australia by their size, right? Share price multiplied by number of shares on issue, the biggest companies by market capitalisation. Okay, so in this question, imagine the value is at 3,500 points, and the value of my portfolio is $5 million, so that's my 50 companies, not the value of the ASX 200. My 50 companies that I'm wanting to hedge is $50, and the beta of my portfolio is 1.5, so it's quite risky. It's 50% more risky than the ASX 200. So simply, it's going to be my beta of 1.5 multiplied by $5 million, the value of my portfolio, divided by, I need a dollar value, 3,500 points times $25 per point to give me 86 contracts. And it'll be a short position because if I wanted to turn my shares into cash, I'd have to sell them. So short allows me to sell for a certain price. Okay, so I need 86 contracts by 200 contracts. Now, what position is necessary excuse me, to reduce the beta of the portfolio to 0.75? Okay, so to reduce the risk. Okay, so the formula I use is B, my actual beta, minus B star, okay, which is where I want to get to, multiplied by P on A. So it's just my current 1.5 minus the 0.75, and then same value of 5 million divided by 3,500 times $25, 87,500 to get me to 43 contracts. Now imagine I want to be stupid and I want to increase the risk of my portfolio. So I want to make it more risky. The only way you can make a portfolio more risky by using futures contracts is to take the opposite position than what you'd normally take. So rather than taking a short position, you take a long position. You're exposing yourself to more risk. You're doubling up on the risk. But we use the same formula. So 1.5 minus 2 multiplied by 5 million divided by 3,500 times 25 gives me negative 29. So the negative means you do the opposite. So rather than taking a short position, you take a long position in 29 SPY futures contracts. Why? Because you're a risk-seeking person, right? You like risk. No one in this room would do that, though, so it's okay. Okay, so basis risk, difference between futures and spot prices. Another thing that happens, right, is what we call rolling hedges. So let's imagine that you know in 6 years' time you're going to have a whole lot of product you want to sell. Okay, so maybe you're a mining company and it's going to take you that long to get the product out of the ground. Okay, all the startup costs, everything you need to do. But of course, to be able to get a loan from a bank, you need to say to the bank, yeah, I've locked in, I'm going to be able to sell that oil in 6 years' time for a certain price. So you want to use futures contracts to do that. The problem you'll face, though, is there's no 6-year futures contract. Right? They're normally only 1 to 2 years out. So what you use is rolling hedges. So you might have a hedge in place for 2 years, then at the end you'll enter into another 2-year hedge, and then another 2-year hedge. Because you're rolling them over 2 times into the second and third 2-year period, each time you roll it over, you'll end up with some sort of basis risk as well. Okay, you'll incur a basis risk. Okay, so that's what I want to talk about today, perfect timing. So your quiz next week, remember, your quiz next week is on valuing forward contracts. I'll put a notice up on Waddle again to let everyone know. Thank you, just give me 1 more minute. Thank you. Thank you. Quiet. So what are you going to need to be able to do in that quiz? You're going to need to be able to tell me initial value of forward contracts, which is, thank you, 0, good. You're doing well so far. You're going to have to be working out whatever the forward price is, which is easy, S0 times E to the power of whatever it might be, R plus Q, R minus D, depending on whether there's some income involved. So you have to tell me the initial forward price. You're then going to have to work out a new forward price some period later on, okay, a few months later, and then you're going to have to tell me the value of, of your initial forward contract at that new date. So everyone should get 10 out of 10, hopefully. Thank you very much. I'll see you next week. So just give me a second to turn off. I just got this guy in front of you, and then I just got to log on. You're right.
So with the worksheet question with the bags, I don't know if you've looked at that. Yep. Is the timeline the same as the one we covered today regarding the bond? How there's like a 4-month gap? Earlier the question was that basically we look at locking to a 90-day bad future. And I wasn't too sure when the difference between voting's kind of period was for actually locking in the actual.
Yeah, so normally with the 90-day BAB, you're locking in to buy or sell that 90 BAB on the day, so you'll still have 90 days to go.
Okay.
But whereas the one today, I deliberately want to make it a little bit, not confusing, but we speak about today it's got a year to go, you're going to buy it in 4 months' time, so it's still got 8 months remaining.
Okay, because like with a commodity one in there, for the bitumen, you're looking at the future price, and then obviously as it gets to the conversion state, they're closed out, and they shows the commodities. But with the BABs, do you do the future and the bonds on the same day?
So normally you introduce a futures contract to buy or sell a BAB on a certain date in the future.
Yes.
Right? So maybe 6 months in the future, and that's when you then buy or sell the BAB, which still have 90 days remaining in its life.
Okay, so yeah. So you buy the future, then you buy the BABs later on.
That's right. Yeah.
Okay, but it wasn't yet really clear when it was
okay, sure. So, yeah, that's right.
So just when you go through lectures, I'm bringing a lot of the I just want to make sure what exactly do I need to know? Just so you know the entire content of the lecture size basically for the exams, or more about what you're saying in the lectures?
I'll probably concentrate on what I'm saying in the lectures, but I'm pretty much covering what's in the lecture slides as well. Right?
Yeah, it's just like it sounds like you skip over certain size, like you sum it up.
Yeah, so the ones I concentrate on what I'm concentrating on.
Okay,
yeah,
no worries, thank you.
Yep.
We'll take the time value, and then sell it and to buy another one.
Well, the problem is because you're not going to want to actually buy or sell the underlying asset, right? When you roll it over, you're probably going to close it out, and we should leave actually. You're actually going to close out.